So what if I gave you the options of a used car, the S&P 500, and the US housing market? Which do you think would have performed the best in the last 2 years? Well, if you had said a used car, you would be correct. Since the beginning of 2021, the price of the average used car is up 35.6%. Now compare that to the average home price, which is up 21.3%, and the S&P 500, which is up around 5%. Now that's not all. Used car prices are 43% higher than the historical trend. 40% of all auto loans originated in the past year, and 82% of new car buyers are paying more than MSRP, which is the sticker price, compared to a year ago. So what's going on here? Why is the car market, out of all things, doing so hot? And is it getting so hot that it's a bad sign for the economy as a whole? So today we're going to be talking about how the market got so hot for cars and why it's probably due for a correction soon. So make sure you buckle up. Today's video will be a crazy ride. Puns for days, am I right? All right, so make sure you drop a like on this video if you enjoyed that dumb joke, and let's begin. So the story of how the auto market became what it is today doesn't actually start with the pandemic back in 2020. It actually starts way back in 2010. With the horrors of 2008 in mind, there was a massive bill passed called the Dodd-Frank Wall Street Reform and Consumer Protection Act. This bill passed in hopes that tougher restrictions and reform would prevent any repeat of what happened in 2008. When I say this bill was massive, it really was. Like, it was 848 pages long. Now, one of the things in this bill led to the launch of the Consumer Financial Protection Bureau, whose job was to prevent predatory lending and other shady practices. Under a new act called the Truth in Lending Act, the lenders had to show you everything about a loan in a way that's easy to understand, but there was one exception. On page 629 of this bill, now this is pretty weird, there's a section titled Exclusion for Auto Dealers. In this section, it stated that the Consumer Financial Protection Bureau, quote, may not exercise any rulemaking, supervisory, enforcement, or any other authority over a dealer that is predominantly engaged in the sale and servicing of motor vehicles. In other words, auto dealers and lenders didn't have any obligation to fully disclose information to their borrowers. That kind of just leads me to believe that they probably just had some really great lobbyists or something, because I don't know how this actually got in there. Anyways, after this act was passed, the lack of regulation for auto dealers and lenders completely changed the auto market. Since 2011, the total auto loan debt in the United States has doubled from $700 billion to $1.4 trillion, and auto loans as a percentage of overall consumer debt has increased from 5.94% to 9.4%. Before, the average auto dealer would make around 70% of their profits from actually selling the cars and 30% from auto loans. After the Dodd-Frank Act went into effect, this completely changed as the percentage of profits from auto loans steadily climbed and overall profits also shot up. Then in 2018, dealers for the first time ever made more profits from loans than they did from actually selling the car. Since they weren't required to disclose all the information to the person borrowing from them, the lenders marked up the interest rates on these loans. That way, they could make a larger commission when handing out these auto loans. Worst of all, they have no obligation to tell you how much they're marking up your loan by. A website, OutsideFinancial.com, tried to calculate how much these auto dealers were marking up their loan packages by, and what they found was the average loan markup is around $2,100, twice as much as what it was in 2010. Even though there was a massive increase in loan markups, vehicle affordability actually stayed relatively stable throughout the years. That is, until we hit the pandemic in 2020. So when the news of the pandemic first started to come out, no one really knew what was going to happen. Anticipating a slowdown in demand, many factories pulled back on production and manufacturers canceled a lot of their orders for key parts. And this is probably where we all got it wrong, because there were a bunch of stimulus package passed in the United States, and that would actually cause a global pump in demand throughout the global economy, so both supply chains and factories couldn't keep up as the shortages piled up. One of the biggest shortages were semiconductor chips, so chances are if you're watching this video on a phone, computer, TV, tablet, or maybe even a Game Boy, it's running thanks to semiconductors. These chips are the backbone for basically all electronics, so if you're building any modern technology, you'll need a lot of these chips. Unfortunately, these chips are very complicated to build, and in fact, the time it takes from when a business places a chip order to receiving the chip can take up to 26 weeks. Now, if there are too many orders piling up and maybe the factory is not running due to a pandemic, it could take even longer. So because of this long wait time, car manufacturers couldn't get enough chips to make enough cars, and at its worst, US car inventory plummeted to only having 20 days worth of supply. Now, prior to the pandemic, auto companies had around 60 to 70 days worth of inventory. Looking at this 5-year chart makes car inventory seem pretty bad, but when you zoom out, there's a different story going on. Since 2014, US car inventory has been declining a lot. After 2008, many auto companies were bankrupt, and there was a massive consolidation in the industry as they slowly regained their footing. But around 2014, something flipped, and that had to do with Tesla. So Tesla and its stock started to gain some traction. In that year, Tesla announced Autopilot and began shipping out cars with sensors and software for Autopilot. The emergence of Tesla was a real threat, leading traditional auto manufacturers to pay attention as they switched the focus to having a lean cost structure and a more focused product mix. This was done so that these auto companies could have extra cash to focus on new technologies like electric vehicles and autonomous vehicles. Now, that might be a little bit of a reach there, but it's definitely interesting timing that auto inventories would decrease as Tesla was coming into prominence. So why does declining inventory matter so much though? It's really just a supply and demand equation. If demand stays the same and supply decreases, then prices will increase since there's less supply for that same demand. All right, so let's go back to the start of the pandemic. At this point, car prices are already rising, but the insane jump in price is pretty crazy. Because of supply chain disruptions and a ton of demand, the material cost of making a vehicle almost doubled the 30-year average. That led to an increase in all of these cars and sometimes excessive markups over sticker prices that we're seeing now regularly. But we also have to talk about the auto loan market, which threw this whole situation even more out of whack. Total auto loan originations increased around 30 to 40% during COVID, and get this, the Federal Reserve found that around 40% of all auto loan balances originated in the past year. This could be partly due to the overall loosening of standards for auto loans, leading to more loan applications, but the average durations of these loans were also a big factor. In 2009, the average length of a new used car loan was 61 months, which is about 5 years. Today, it's closer to 69.5 months, a 14% increase, or closer to 7 years. Longer payment terms make each monthly payment look more affordable than it really is. Even though the average used car was up 31.7% from 2020 to 2021, the change in the average monthly used car payment was up only 18.2%, so much less. These longer terms make the car look cheaper than it is, but you could end up owing more than what the car is worth if the market changes. If car prices come back down and people try to sell their car, or if it's totaled in an accident, the money offered from a buyer or insurance company might not cover the entire loan balance. Longer payment terms also brings more risk to the lender. Normally, you would think that lenders are more willing to offer longer terms to higher credit score people rather than subprime credit score people, but that's not always the case. The Experian Credit Agency found that subprime borrowers, which have a credit score between 300 and 500, on average paid a lower monthly payment on new cars than those in the prime credit score range. That means that higher credit score people are buying more expensive cars, or what's most likely the case is that subprime borrowers are getting longer terms than normal. Now, what's surprising is that both are probably actually true. While the average auto loan is around $9,000 larger for prime borrowers, subprime borrowers typically have terms 1 month longer than prime. Having loan terms of over 6 years for subprime borrowers definitely brings some trouble to the auto loan market. A longer loan term will increase the chance of default, especially if those borrowers are subprime. This brings an interesting spiral scenario. So if delinquencies start to pick up, then repossessions might start to pick up, which leads to lenders not as willing to lend. That would result in higher borrowing requirements, less demand overall, and a decrease in this type of demand would lead to higher rates, which increase the cost of borrowing. Now, Morgan Stanley recently found that subprime delinquencies have hit 10-year highs, and all credit score ranges have seen delinquencies go up as well. What's also interesting is that the difference in delinquencies between the higher FICO credit score range and the lower FICO range is at the largest since 2012. That kind of goes to show that the recent economic environment that we're in is hitting the riskier borrowers a lot more, or the people that have lower scores. Ford CFO also recently came out and warned that the US auto loan delinquencies were also rising. These delinquencies have already led to both subprime and prime repossessions of cars. Barron's recently found that, quote, subprime repos have nearly doubled since 2020 to around 11% on average. The scary part is that while usually about 2% of prime loans are repossessed, that rate is now 4%, or almost double. Later in the article, they also mentioned that banks were giving auto loans at a loan-to-value ratio of 140%, but those same loans are now selling for around 70% on auction. So a loan-to-value ratio is the ratio of the loaned amount to the actual value of the car. A high loan-to-value ratio means that the bank is taking on more risk by lending you more money relative to what the car is worth right now. And because of this, the banks are losing money off of these higher risk loans. So Ally Bank, a big auto lender in the United States, has also had some interesting things to say about the auto loan market. In their their most recent earnings call, they talked about how they had the highest quarterly level of auto originations since 2006. When you look into their earnings presentation, it shows you that the delinquency rate for their auto loans have been increasing every single quarter. Obviously, this is just one of many banks in the country, but it's interesting that they're already anticipating a slowdown of some sort. In June, vehicle sales declined 17% compared to a year ago, which was below Wall Street's expectations. Now, with the Fed raising rates, this will also cause auto loan rates to rise. JD Power expects rising interest rates will cause a $15 billion loss in used vehicle sales and another $7 billion loss in new vehicles. So if you're in the market for a new car, this is what it means for you. There's a couple things that you need to know. You gotta be very patient. The end of 2022 and early 2023 will probably be a better time to buy a car as the inventory recovers and the chip shortages end. Studies have also found that the best times to buy a car is at the end of the year in November and December due to high volume of trade-ins as people take advantage of end-of-year sales and incentives. So if you already have a reliable car or live in an area with decent public transport, the best decision will be to hold off on buying a car. If you're looking to sell your car, this might be a good time to sell while prices are still high. It's possible that dealers still will pay you more for your car than what you bought it for. There are some cracks showing in the car market, and we're gonna have to see what happens, and we could also see some massive shifts as the economy tries to find stable ground. So for the time being, just stay patient. Make sure to sign up for my free newsletter Hump Days. It comes out on Wednesdays and Sundays. It's completely free and the link will be down below. If you like this video, you may also like my video on the 2022 housing crisis, which I will leave linked like right here. And I hope that you enjoy that. I'll see you in the next one. Peace.